Hey everyone, it's Imran from Options Insight, back with another macro options spotlight.
Remember, like, subscribe, comment. We want to get this all over the place.
Okay, big day yesterday. We had Powell coming in on FOMC. Market was kind of setting up for him to talk tough, given that we were seeing loosening of financial conditions and a pretty decent rally so far this year. That was what the market was kind of thinking. Market was disappointed by that. Well, when I say disappointed, the bears were disappointed, because he did not push back at all on loosening of financial conditions, and stocks ripped higher. Again, led by NASDAQ, which was up about 1.5 sigma, which was over 2%. Again, it's actually carried on rallying overnight because Facebook's indicating up best part of 20% on beating revenues and a massive stock buyback again. European markets have played some catch up as well overnight. So they're pretty buoyant as well, with ECB coming out any minute now. Then you've had Asia steady as well. Commodity-wise, they were mixed. Gold still continues to be bought on dips. Very, very shallow pullbacks in gold, whereas energy's still a bit under pressure. We have seen higher inventories in oil that continues to come in. That gas doesn't seem to have found a floor yet, down to that $2.50 level that I've been talking about as a potential target, where maybe we could see some sort of bounce, some sort of reaction, right? But just the fundamentals don't look great by the looks of it in that gas. And then copper did try and have a pullback as well into the low 4 area. Has rallied since then with the FOMC move. But yeah, it looks like copper's taking a breather, but it does have reasonably good support around that 4 level. Volatility wise, absolutely smashed. As we've been saying, we anticipated a bit of a vol sell-off, as you normally get on these sort of events. So down best part of 2 vols in the US indices. Europe not moving anywhere near as much, but that's because they didn't have really any premium in them. Let's see if they find some sellers though after ECB and Bank of England, because look at the positive carry. It's ridiculous. Positive carry, 60-70% in these European indices, because they're realizing not just single digits, but pretty much low single digits relative to implies that are still at 15. So it may well be that European vols need to take another leg lower after whatever move gets digested out of the ECB today. Looking at commodity vols, they're also softer, apart from nat gas that was bid. So just continuing the theme, lots of positive carry there in commodities as well. So generally being on the short side of these elevated vols relative to realized has been the right way. And then skew wise, we did see skew come in there in the US indices. That was basically partly because it had caught a little bit of a bid before, as people look for protection around the FOMC. That kind of faded along with vol, but also as we rally to a flatter part of the skew surface, right? Skew, the volatility structure, the volatility surface is not a kind of symmetrical thing. It has convexity in it. It has various shapes. And as you rally, you often rally into a flatter part of that surface, where skew is actually flatter than it was before the rally. And that's what we've seen there, as those skew numbers have been coming back down. They're still higher than they were at low levels that they reached last year. We do think that's because upside call selling is back. Investors have added exposure back to the market, and they don't mind selling calls against it. And there's less of that potential squeeze risk outside of NASDAQ, which has seen a bid for calls lately. We think that squeeze risks are somewhat mitigated in the likes of S&P. And then lastly, in commodity skew, a bid coming back for oil and uranium puts, which are now looking a little bit elevated on a percentile basis. Okay, what else? Dovish reaction from Powell. So, looking here, that there's Bloomberg put these measures together where they look at the statement from the FOMC and sort of hawkish sentences, dovish sentences, etc., and kind of try and get a gauge of how dovish or hawkish the report was from the FOMC. And we can see it's kind of the most dovish in about a year. So that kind of confirms what the market reaction was, that they are relatively dovish. And then the press conference really was Powell's chance to push back on financial condition loosening, and he chose not to, basically. So that's what the market liked, and that's why the market rallied. Also, the systematic communities got pulled back in. CTA equity exposure has ripped quite a bit higher so far this year, from short back to long. So the CTAs are chasing that price momentum. Definitely been a large reason for the rally. Implied volatility resetting down after the event also pulls in buying from what we call this Vanna effect that we've talked about many times. Given the structural positioning of upside and downside options in the market, when vol levels come down, it brings buying from dealers who are positioned a certain way. And then, like lastly, I said Meta jumped 18%, because they've announced a $40 billion buyback and they beat on revenues. And NASDAQ futures have kind of popped on that, and they are well above their 200-day moving average now. With other mega caps reporting tonight, like Apple, Google, Amazon, if those numbers are half decent, then we could see further upside on the NASDAQ. So just that thing really has got going. Now, in terms of trades, no new trade idea, but I thought what I'd do is a review of a trade idea we put out 2 weeks ago. And this was the Qs call spread versus the DAI, which is the Dow Jones ETF call spread. We had basically said we thought if the market was going to rally, people were short tech into earnings season, there was a squeeze in tech due, and the way we would kind of get smart exposure to that without committing too much was via buying a call spread on Qs and selling a call spread on DAI. Since then, and we've got the dotted line here, it was the 18th of Jan, we talked about this. Since then, Qs are up 9%, DAI is only up 1.5%. So we had a 7.5% outperformance in that trade. The trade structure that we had kind of suggested was a 5-point wide call spread on Qs versus a 5-point wide call spread on DAI to just make it kind of like for like. The net cost of buying the Qs versus the DAI is spending 10 cents, so it's close to zero cost. As it's transpired, the net pricing now is that the NASDAQ, the triple Qs call spread is $2.7 more than the DAI one. So we've got a decent uptick there from spending next to nothing. You've now got $2.5+ P&L if you did that trade. Personally, I didn't do the trade in my overlay portfolio. I had other sort of tech longs anyway that I didn't feel the need, and I was waiting for a better entry point, so I missed it, unfortunately. But if any of you guys put it on, well done. I do think now the leverage is not that great. You've got something that's 2.7 in profit. The most it's going to make is like $5, and basically that's not giving you a lot of leverage, right? So it's especially, we got a load of risk that if Apple, Amazon, Google, if they rock the market and turn it back down, then you'll start giving up money and you haven't got loads of upside leverage from here. So what I would do is I'd probably take profit on this structure. I'd buy back the Dow Jones call spread. I'd sell out this one because it expires on the 17th of February. And if I wanted to maintain further upside to the NASDAQ, I would do something like a March 320, 330 call spread on Qs, which costs around $2 for a $10 spread, which is basically giving me a 4-to-1 risk reward, which gives me leverage to my capital. I wouldn't reinvest everything that I've made on this trade into the March if my conviction is not super strong, but I would take a slither of what I've made. I'd stick it in the March call spread, knowing that that's all I can lose now. I banked a bit of profit and I've got 4-to-1 leverage on my money still in the game if we do continue to rally, right? And we look here, this is the relative performance of the orange line is DAI, the candle chart is Qs. If Qs wanted to catch up with that Dow Jones outperformance, it could motor up towards 320, 330, basically, right? So if this squeeze gets going, who knows how far NASDAQ wants to go, right? So I'm not necessarily calling for it because we have had a decent move up already, but it's possible, right? If people want to start addressing these shorts aggressively and the numbers come out good from the big caps, anything's possible. All right, so that's the trade review. Just thought I'd throw it out there. So if anyone who did manage to get it on the books, how to think about it, how to think about rolling, restructuring, taking profit, that sort of thing. And then lastly, we've got metals. Gold has been outperforming. So since the start of the year, obviously copper and gold kind of were flying together. Copper's had a little bit of a breather since then. Copper's the blue pulling back here. Gold had knee-jerk higher after the FOMC. Silver has started to join the party, but is still lagging massively from the start of the year. But these are kind of your three big metals to keep an eye on. One thing to note is gold, whilst it's made new highs in spot, it has got a bearish divergence showing here where the momentum indicator isn't quite as high. And then if we look at the strategy compass, gold puts are kind of screening as a pretty decent mean reversion play here. So if you have been long gold, if you are a little bit kind of nervous that it's looking stretched, it's showing some divergences, you might want to buy some puts against it, right? If it's a structural long that's going nowhere in your portfolio, you're not going to want to sell it, but you do always have the option to buy some put protection. GLD puts are now looking relatively cheap as vols have come down. Spot is looking obviously quite stretched with that RSI up near 70. So you may want to layer on some puts to hedge any longs that you've got for a short-term move. I'm long some Februaries. They don't look like they're going to make me any money because they're quite far out now. I haven't done anything to replace them yet. But, these are sort of considerations that you want to think about if you're running long-term money and thinking about short-term tactical things against that long-term money. All right, that's it for me. I'm done talking. Hopefully catch you on Options Insight Live, our Twitter spaces that we run every Thursday at 11 a.m. Eastern, and I'll catch you soon. Thanks.